Thanks for tuning in to Bloomberg Quint on our special series Navigating Through Uncertainty. With me to talk about how the next 6 to 12 to 18 months and uncertain months could look like is a veteran of the Indian markets, arguably the global markets as well, in a new avatar of sorts, Naganath, President and CIO. And I'm reading out from his card, Franklin Templeton Alternative Investments Limited. Naganath, thanks so much for joining in. It's a pleasure having you.
Thank you so much.
So I think the reason why we chose this topic and the reason why you're doing this small series of sorts with eminent experts like you is to try and figure out just how uncertain could the next 12 months be, because if 2017 was all about throwing a dart and getting it right, 2018 has been anything but that.
Absolutely.
What does the remainder of 2018 and arguably the first half or the second half of 2019 hold in store according to you?
Well, in a few words, volatility and more volatility.
More volatility.
Yes, absolutely. I think, as you rightly pointed out, 2017 was a year when you had a bull market in equities across the world, including in India. We had a fantastic year. 2018, Feb, March told you that volatility can re-emerge, and it did. And then we forgot about it in April, May, June, July, and August until we got to see it again in September, October, not just here, but across the world. My sense is that investors are slowly waking up to the possibility globally that growth could slow down in the next year or two. And there are reasons for this. One is the trade tariff issues. I think initially people did not pay enough attention to it. And for some time I thought that, people should be focusing more on this because this has the ability to eventually slow down global trade, disrupt supply chains if the trade tariff issues intensify. And all of that could have a chilling effect on global growth. And now I think I see a lot more mainstream news articles and opinions implying that, yes, that could be a potential cause for concern, unless it is resolved in the near term. The other is that the trade tariff issues did lead to some currency volatility, and you could see more of it, as some countries that are affected by it look at the potential for some degree of currency depreciation to blunt the impact of the higher trade tariffs. And often currency volatility can then spill over into equity and bond markets, and then that has its own set of variables and other factors that come into play once you have higher currency volatility then affecting bond yields and stock price valuations and so on and so forth. So I think if I look out over the next 6 to 12 months, my sense is that the trade tariff issue could continue to be a leading factor in contributing to this elevated volatility in the markets.
Interesting. Now, you started off this answer saying the global growth numbers could look patchy, for lack of a better word, patchy over the course of the next 12 months. If we look at the Chinese numbers, they are already showing signs of that. India thus far resilient, but not as large a player as some of the others. The US GDP print seems to be on course. The latest data doesn't seem to be all that bad, but corporate earnings in this season thus far have shown some wrinkles in the armor. Now, is that a worry as well, that what happens to US GDP? Because a lot of people, Naganath, are actually saying that if the US GDP slows down, it might be bad for that economy and maybe for global growth, but certain EMs could actually do better at a point of time when the market is less bullish on US and has to look out for other avenues.
Well, I'm no expert on the US economy, but from what I read in analyst reports and what I read in the press, I think the sense that I get is that the markets there have discounted pretty much the benefits of the tax cuts. And so many experts are of the view that the positive impact of the tax cuts would sort of start fading out by middle of next year to late next year. Also, you have potential for wage inflation, given that the unemployment rate is now very low, right? So the sense that I get reading all those reports and articles is that potentially by the second half of 19 into 2020, growth could slow down relative to what we see now. And if, like I said, the trade tariff issues continue to rumble on, then the potential for growth slowdown elsewhere also is equally high. As you know, financial markets typically tend to anticipate all these growth slowdowns many months in advance, but sometimes even as much as a year in advance. So in that respect, 2019 could be the year. If I'm correct about a growth slowdown across the world in 2020, then 2019 could be a year when You have markets reacting to it. Maybe they've already started doing so. And therefore, from a financial markets point of view, the time period to look out for and watch out for in terms of this higher volatility, potential drift in prices in equities and bonds could be, effectively 2019.
Okay, so the bear thesis, and I would presume that even now there are some people in the bull camp and some people in the bear camp. The bull camp believing that even if there's a slowdown, it will not morph into a recession, and the Fed rates won't be as quick as maybe the bears anticipate. The bear thesis seems to be what you said, that wage inflation and therefore leading to higher inflation and therefore faster rate hikes, and that being a problem for flows as well. Which camp are you in? If you are in one.
Well, nobody can predict a recession. You will know it when you're actually in one. So my point is this, from March of 2009 until recently, you had one of the longest bull markets that many market watchers have seen in a long, long time.
True.
What was contributing to this bull market? You had immense QE, quantitative easing. You had ultra low rates, zero rates. Both have moved in the opposite direction. You have retraction of that liquidity. You have rates moving up. So if QE and zero rates were good for equity markets, then you have to logically argue that retraction of QE and higher rates or non-zero rates are obviously not that favorable for equities. On top of it, you have the trade tariff issues, which, given the its recency, can cause a slowdown in growth, can cause higher inflation, that causes higher rates, So then what does it do? Basically, if you are a corporation, you have now to deal with higher interest rates. You may have to deal with higher wages because of the tight unemployment situation. You may have to deal with higher cost of intermediates because of tariff issues. You may have to deal with lower demand because of higher price of goods. So there is a potential squeeze in profitability that was not on the horizon maybe even 6 or 9 months ago, right? And therefore that has the potential to crimp P multiples, which in the meanwhile have been moving up quite nicely in the last many years. So my point is, even if we do not have a clear fix on the earnings trajectory, the fact is, given elevated Ps in the last many years, you could see a sharp contraction in that in response to one or more of these factors, and that then causes a downside to equity prices across the world.
So many equity watchers would not have seen such a scenario. You have. And therefore, my question is, what do you feel? What does your gut tell you about which way the winds are blowing? Is there a higher probability of the drift downwards and a significant drift downwards, or not quite?
Well, let's start with what we see in the near term and what we see, over a medium term. I think the September-October sell-off has been very, very significant, very severe in terms of many markets losing, 7, 10, 15% in the course of 2 months. I think many markets, including Indian equities, are looking very oversold to me right now. And therefore, I do expect a strong rally. And we've seen one today itself. I expect this to now, markets to rebound now. And this could be a short covering driven rally, or it could be a relief rally. You can call it by whatever phrase you want. And this may well manifest over the next, month to 2 months or so.
Interesting.
After which, there could be another reassessment of economic conditions. If the tariff issues are resolved in the interim, maybe then the rally continues for longer. On the other hand, if it comes back and it is unresolved and there's even more friction than what we've seen before, then equities may again face some weakness.
Interesting. A lot of conversations with people, Naganath, seem to suggest that if there is a full-blown trade war in place, it might actually augur well for a country like India, which doesn't get too impacted. At least that's what certain conversations have been around. And for a market which has fallen 10-15% and is amongst the highest growing major economies in the world on the GDP front, all of this might augur actually well for India. Where are you on that argument?
Well, I have read, some news articles about that, and certainly there is potential to be relatively more competitive, but that's from a supply point of view, right? The issue is really what happens about demand. If you do have higher priced goods because of tariffs, or you have inflation due to other issues, for example, oil prices, which were at 60 are now close to 80. And some argue that it may get to 90, some say it will go back to 70. I think the picture on oil is not that clear. But for a moment, even if it is where it is certainly much higher than where it was, 6 months ago. Does that crimp demand? So we have to look at the demand picture as well. If the sense is that the demand is also beginning to look weaker, then your competitiveness on the supply front will certainly help you in terms of market share gains relative to other countries. But the end demand also has to improve. And if that doesn't look likely, then overall trade volumes could still remain subdued.
But lower growth equal to maybe lower crude demand, equal to maybe lower than expected inflation, all of that for a country which imports dollops of inflation might not be that bad?
Yeah, I think if you're talking about India's oil imports, I think it's going to be highly beneficial for us. But again, all this will settle down in the next 6 to 9 months. Certainly, if there is likely to be a growth slowdown, as I anticipate in 2020, reflected in markets in 2019 or even from now, maybe this spike in oil prices is just a flash in the pan, and eventually oil settles down much, much lower, which will be hugely beneficial for India. But like I said, that may not help you in terms of export growth if global demand is subdued, but at least you'll benefit hugely from lower oil prices. Likewise, that will help the currency, which has depreciated recently, to sort of begin appreciating again. And one other point which I'd like to make, which often is not mainstream, not a focus of mainstream analysts, is gold. We have lots of gold in the household sector, years of buying by households as an investment, not mark to market, right?
True.
It's held as a real long-term asset.
Yeah.
And, we've spent lots of dollars buying this year after year after year. But, if over the next 3, 5, 10 years, there is a feeling that inflation is now back, and, in the aftermath of the GFC in 2008, people said, oh, there's so much QE, and where is inflation?
True.
Inflation never came because much of the extra liquidity actually went not into the real economy, but into the financial markets. Where was the inflation? It was in financial assets. Bond prices went up, bond yields fell, equity prices went up, and P multiples went up. So the inflation was in financial asset prices, not necessarily in the real economy. But now my instinctive view is that the real inflation is going to come back because of tariff issues on the one hand, maybe temporarily higher oil prices, wage pressures, etc. You may have supply disruptions because of supply chains getting impacted, etc., all of which contribute to these price increases. And if at all, you have, hypothetically, another round of QE in 2020 or beyond, because there is a recessionary situation, then this time around, my view is the bond market may not take too kindly to QE, and in fact, yields may go up as opposed to going down, right? So, the coming back to gold, all I'm saying is, if gold prices move up in response to what the markets perceive around the world as higher inflation, I think this latent holdings of gold in the household sector in India will see a significant wealth impact, which I think is very underappreciated today by the markets.
Well, if not anything, the sentiment definitely improves.
Sentiment will be good. Plus, the fact that you have an asset that is not marked to market and held by, millions of households will certainly have a much higher wealth impact, which can then influence consumption, deleveraging if they have household debt and so on and so forth. So I think it's a hugely underappreciated asset in the hands of every household in India.
Maybe won't remain after this. Yeah. But, okay, just one more question before we dwell into certain specifics about India.
Sure.
Does anything on the macro front or external front worry you? We have a busy election calendar over the course of the next 7 odd months.
Yeah.
Whether that is a big worry or not quite, and do any of the other factors, the twin deficits, etc., worry you enough to derail any kind of optimism that might come into India if indeed there is a bit of an earnings surprise? And I use the term surprise simply because we are all hoping for this year to be that year of earnings growth. Somehow Q2 has been a bit of a dampener thus far.
Well, earnings growth has been okay. Every year we start with the expectation of a 15% or higher earnings growth, and then we've had to slide back and end up at single digits, 8%, 10%, etc. I thought April, May, June earnings were quite okay. July, August, September, not as good as initially anticipated.
Yeah.
And maybe for the remainder of this financial year, it will be okay. I don't think it's going to be vastly different either on the positive or the negative side, as in not too many more surprises on the earnings front, I think. But look, we've had to deal in the interim with higher oil prices, with a weaker rupee, the issues of the twin deficits and so on and so forth. I think pretty much everything is in the price right now, And therefore, like I said, in the very near term, I'm anticipating a very strong rally in Indian equities. I wouldn't be surprised if we get to 10,800 or 11,000 within the next couple of months. You saw the strength of the pullback today itself, especially in financials. I think the resolution process for companies that are in financial stress is also working well. And so combination of all this, and like I said, if we do have moderate oil prices in the coming months, plus if you have a resolution of the trade issues globally, all that will contribute to this positive sentiment. And, all that augurs well for the stock markets here, at least in the near term, the next couple of months. After which, as I look into 2019, then we'll have to see how the global cues play out.
Sure.
Be it the potential for slower growth in the West, trade issues still simmering, not simmering, resolved, not resolved, etc., and where oil prices eventually settle.
Interesting. So let's talk about some pockets, and then I would also want to dwell on what you're doing currently in your space, because now your role is materially different from what you probably used to do in the past.
Yes.
But you mentioned about financials.
Yes.
How is your view? What's your view there? Because there has been a sea change in financials as we see it, right? And the opinion out there is sort of right split down the middle. There's equal number of people saying that let's stick to quality retail focus. There are equal number of people saying no, it's time for corporate lenders now to come back to the fray. And NBFCs have been the talking point of town the last 2 months.
Yeah. Well, I think like the pharmaceutical sector, now people will start looking at individual names more keenly than they did at the sector as a whole. Don't forget that this sector has done extremely well in the last many years, highly overweighted by most institutional investors. And that was the right trade. They got the full benefit of the nice uptick in prices across the sector. But given the recent issues in some pockets, I think there's a reevaluation. Today, for example, you saw some banks move up sharply and some banks,
go down,
which were held quite a bit by many, decline mildly in value. So that tells you there's a bit of rotation, within the holdings there. My sense is that this sector is the largest weight in any benchmark index and will continue to be so. We have some excellent institutions represented in the sector, and they will continue to have a high degree of investor interest. And the state-run banks today, I saw that they did very well. And like I said, if the resolution process continues to work nicely, as I think it will, then I think they will also benefit from this uptick in sentiment.
There's a set of the opinion seems to be right now that let's look at the markets at large, which includes probably financials as well, from a prism of two buckets. One is retail and one is industrials. And if the last 7 years belong to retail, by virtue of which retail-focused banks, discretionary, etc., all rallied, now is the turn for the industrials to come to the fore. And corporate balance sheets are deleveraged for them to be able to find funding and execute plans.
Yes.
Would you concur?
I think both will do well. There's nothing to suggest that consumption will slow down meaningfully. At the margin, there could be some ups and downs as far as the consumption growth is concerned, consumption demand is concerned, and the growth of the consumption-related stocks. But I think that will be an enduring part of this, this country's, bullish uptrend over many, many years. If you see the large technology companies in the West that are investing here, the attraction is the huge market, which has taken to technology very fast, right? If you see the e-commerce sales here, you have representation by many large companies here, and that points to the importance of this market for them. And the fact that the adoption of online buying, etc., has picked up very nicely. So I think consumption as a trend here will continue to be a strong one. Again, within the sector, you'll have to see which one is overvalued and which stock is undervalued, and accordingly make your decision. But that theme will continue to be an enduring theme in the minds of most investors.
Including yourself?
Yes.
Okay.
In a quarter, you may like one stock versus another, but you're not going to say, I don't like consumption stocks at all. I don't think that will ever happen. Industrials, I think, has been neglected in the last many years, and rightfully so, because there was no real uptick in capex. Much of the spending was happening in the government, from the government side on capex. I think that cycle will now start. Maybe it starts after a year, or maybe it starts in 2020, or the second half of 2019. But as you know, markets, once they sense it, maybe the uptick in the stocks of these industrials will begin anytime from now into the first half of 19. So if you're an astute investor, you might want to actually focus on those in the next few months, then wait for the actual cycle to pick up, which I think will happen, maybe second half of 2019 into 2020.
Are you thinking about them at all right now?
See, in the business that I am in now, alternative investment funds, it's a long-short investment strategy, which is quite helpful in times like this where the markets are volatile. But equally, the expectations are that you deliver absolute returns regardless of whether the market is up or down, and try to minimize your downside risk. So the investment horizons are much shorter. You have to be much more agile trader in stocks. So our typical investment horizon is about anywhere from a few days to a few months.
Interesting.
And typically our positions are based on how we see the markets or individual sectors or stocks over the next 30, 60 days.
Interesting. So, okay. So let me try and dwell upon that. And I would want to know how is it that this product or such a thing is finding acceptance as well.
Sure.
But since you mentioned a couple of times that you do believe that there is an outside chance or a realistic chance that we may actually see a rally from the current levels all the way to maybe 10,800, 11,000 over a period of the next month, month and a half. What do you think drives this?
I think short covering is one, because the decline also happened over a 2-month period, right?
Within the ones which are beaten on the most, or how do you think it works?
Well, I think, financials, is a sector that got hurt quite a bit. So, they have rallied today. I think they'll continue to do so. Autos, if the festive season numbers actually eventually surprise, you could see an uptick there again, initially led by short covering and then by follow-through buying. Metals, another space that hasn't done that well. The energy sector. So there are enough and more sectors that have not had a great run in the last 2 months. So all of them, I think, will start showing some uptick. And then you could, once, like I said, these trade issues and other, you have some degree of appreciation in the currency because of lower oil prices, and people say, oh, okay, the oil prices went up, but now they seem to be settling down and not moving this way or that way in any volatile fashion. Then the beneficial impact of that will, show up in the appreciation of the currency. That will in turn trigger some, foreign inflows as opposed to the outflows we saw in the last month or two. So you'll have a series of, I think, potentially positive factors that contribute to the sustenance of this uptick beyond the initial round of short covering. And then, maybe once we get back to 10,800 or 11,000 or maybe 11,200, then there could be a reevaluation at that point based on the earnings for the December quarter. And then the state of all these factors I alluded to earlier in the international context. And if the view is that nothing much has changed, maybe then you have a sort of a range-bound market for a period. On the other hand, if those issues again come back to the fore, you could have another round of correction.
In that sense, the markets and the Fed are in the same boat, data dependent.
Well, I mean, pretty much every investor is also now, in that same boat. We have to look at the data on a more continuous basis than before. Because many trends have, sort of been interrupted given the market correction globally in the last 2 months or so.
True. You didn't mention one pocket, and I was intrigued. Export-oriented themes at all. I mean, one would presume that with the currency doing something that it has not done for the last 4 years, which is correct,
right,
it makes exports a bit more competitive. IT, pharma, specialty chemicals, textiles, what have you, auto ancillaries. I mean, do you believe that those sectors could surprise positively?
Well, I mean, just based upon currency depreciation, if you were to make an assessment of export,
no, I'm saying that's an
export growth,
competitiveness measure.
Yeah, I mean, logically, one could argue that should be the case, right? That you have the ability now to be more competitive. But like in many businesses, the buyer also then wants you to lower the price because he wants to share some benefit of that currency depreciation. And it's not just that the rupee has depreciated; other currencies also have depreciated. So it's about relative depreciation versus other EM currencies. And most importantly, like I said, what is the state of the end demand? Is that end demand robust, or is it actually slowing down? In which case, then volume growth may not be as robust as one initially anticipated.
Okay.
And which is why if you look at the tech companies, they have also corrected. One should have expected that given the depreciation of the currency, they should have actually held on to the gains they made through the course of the, although they did very well in 2018.
Yeah. So is that a valuation call that the market's made?
I think it's partly a valuation call. And partly the fact that you made so much money that when the market's correct, you want to crystallize those gains, and therefore you book those gains, and therefore selling to book profits also could have been one reason behind the...
It's not happening in the consumers thus far. While you can argue that some of them have also come off, but the P multiples still remain elevated, much higher than the 5-year averages.
Correct. So many of them are sporting P multiples that are very, very expensive relative to long-term averages, etc. But because they have not done as much in terms of return as the tech sector, maybe the holders of those assets or those securities are of the view that let's keep it for the longer term. But like I said, if one or the other large holder were to sell and the prices were to fall, then maybe all these other holders will also start reevaluating their options. So sometimes you need a trigger to initiate a fresh thinking on the subject.
Interesting. So tell me now, how has the experience been about this new product that you've launched? How are people accepting it? And what is it that investors can expect from products like these? Because I would presume that a lot of other houses make a beeline to launch something like this, if not already.
Well, I can't speak for other asset management houses, but at Franklin Templeton, we launched the Franklin India Long Short Equity AIF, Alternative Investment Fund, last month, and the initial launch was successful. We raised close to about 539 crores. And, the fund basically focuses on trying to generate absolute return with minimizing downside risk. We can go long stocks, short stocks. We can use derivatives, futures, and options. And when I went around to meet prospective investors and also distributors, I think the view was that, look, in this heightened or elevated volatility environment, perhaps a strategy like this actually is interesting. And, over the next 6, 12, 24 months, if this volatility were to continue, then perhaps one should take, it's considered some allocation out of an investor's portfolio into a strategy like this. So there's a lot of interest among HNIs and family offices in particular. And that has been very interesting.
Okay. My final question on this conversation, and that's about whether you, in this rally that we'll, well, from a bull's perspective, hopefully see, or in the subsequent moves that happen, do you believe that the non-index names, and by that I'm largely referring to the mid-caps and the small caps, can they make a meaningful comeback? Because until 2017 it was all about what the broader markets did. Somehow they've gotten clobbered badly in the last 3-4 months at least. Can they make a comeback?
Well, I mean, technical analysts who follow this, do make the point that yes, there could be a comeback, but to assume that all mid caps and all small caps will bounce back with equal vigor and gusto may not be the case. I mean, each one according to their financial prospects, etc., has to be considered.
Now, if you allow me to interrupt, sorry. So I didn't mean the index per se, but what I'm trying to get a sense from you is that hypothetically, if you are deploying money right now because you're finding value in certain pockets, are you even looking at the smaller end, or are you keeping yourself largely restricted to the largest top 100, 150, say 200 names?
We are limiting our focus to the large cap companies because that's where the liquidity is.
Okay.
Yeah. So, again, we take short-term trading views, so what you need is liquidity. Yeah, so we would rather like to focus on those stocks where there is ample liquidity, and that is in the large cap segment.
Okay. Great. S. Naganath, thank you so much for taking the time out and being with us.
Thank you so much.
And sparing your time. And all the best
Thank
with
you.
the quarters ahead.
Thank you
so much. And viewers, thanks for tuning into this very special interaction.